What's going on, guys? I'm Arkhamtrades, and in this video I'm going to give you guys a simple 3-step model that you guys can use today in 2025 to make over $1 million worth of funding trading NAS100. This model is very simple, going over daily buys, utilizing the higher time frame points of interest and lower time frame points of interest, and as well as clarifying what is an SMT divergence and how we can use it as an additional confluence to catching the highest probability trades. A lot of value inside of this video, as well as towards the end I will be giving you guys a free gift, so stay tuned. But before we begin, make sure you guys click that like button. It only takes 2 seconds and it greatly helps the channel. Thank you. So the first thing that we want to identify is our higher time frame narrative, and that stems from these 2 layers. That's going to be our higher time frame points of interest and our liquidity pool. And our higher time frame points of interest is referred to as our support or resistance levels, and the 3 points of interest we want to focus on is rejection blocks, order blocks, and fair value gaps. And these are our premium levels of resistance or our discount levels of support. And the liquidity pools that we want to focus on is prior daily highs and lows, prior session highs and lows, 4-hour highs and lows, and equal highs and lows. In this depiction, we can identify all of our liquidity pools. The equal lows, price comes lower, that's our drawn liquidity. Then the equal highs, that's our drawn liquidity, price sweeps those out, then comes lower. Now these prior session lows are our draw on liquidity as well, plus these previous daily lows. So we sweep those out, then we see this push higher. Now we have these previous session highs and these previous daily highs. Price comes lower, takes out this previous 4-hour low plus this previous 4-hour high. Then we take out those previous daily highs. So prior daily highs and lows, prior session highs and lows, 4-hour highs and lows, and equal highs and lows are all levels of liquidity that the marketplace targets throughout the trading day or the trading week. And the next we will want to pay attention to is the SMT divergences. These are like the footprints of the markets following price tapping into a higher time frame narrative. But an SMT divergence is simply when we have 2 correlating markets. In this example, let's say S&P 500 and NASDAQ, one market comes lower to take out a prior low, while the other correlated market fails to take out that same low. So from this market taking out this low and this market failing to take out that same low, that is our SMT divergence. And this then creates a divergence between the markets, and that divergence can give us the footprints of where price is likely to go next. So if we have a divergence at the lows, most likely price is going to see higher prices. Vice versa, if we have a divergence at the highs, price is most likely going to see lower prices. As we can see, this market, let's say the S&P takes out this previous high, while the NASDAQ fails to take out that same high. This is a divergence at the highs, and we can see lower prices. And these are some of the most popular markets that you can use when looking for SMT divergences: the NASDAQ and the S&P 500, GBP/USD and Euro USD, NZD USD, AUD USD, XAU USD or XAG USD, as well as you can use the dollar for USD JPY, USD CHF, and USD CAD, as well as when trading Bitcoin, you guys can use Ethereum. It's very important that you're paying attention to your correlated market when you guys are identifying SMT divergences. Now I'm going to take you guys to a chart and show you guys this in action. If you guys are getting a lot of value from this video, me and my brother do have a free course. My brother is Spec Trades. He has his free course right here, and I have my free course right here. Over 2 hours long worth of educational content, as well as we do have today's PDF inside the PDF section if you guys do want today's PDF, as well as additional ebooks and much more. And if you guys do want to live trade with us every single morning, plus access to 100+ hours worth of additional lessons between me and my brother, courses, as well as trading models, that's going to be the first link description. You guys can join the Spark Train VIP community. It's only $47 a month, but if you guys can't afford it, that's completely fine. Me and my brother do have a free course which you guys can check out. That's the first link in the description for completely free. So we're looking at NAS100 here, and when we're trading a market like the NASDAQ or in indexes, we want to prioritize the New York session. So the specific times I'm looking to trade this market is between 7 a.m. EST to 11 a.m. EST. And before this, 30 minutes to an hour, we want to create a daily bias, right? Daily bias could be something that can be a little tricky for you guys, and in this video I'm going to help simplify that the best way that I can. So we want to identify our higher time frame points of interest. So I'm on the 1-hour time frame here, and I want to identify my 1-hour levels of liquidity, as well as my 1-hour levels of support and resistance. So the first thing that I can take note of that catches my eye here is obviously we do have these previous daily lows. Like I mentioned, prior daily highs and lows can be key levels in the market. marketplace that price can use as a draw on liquidity, meaning that if price were bearish and we were to see lower prices, these prior daily lows would be an area that the marketplace would most likely want to target. As well as if I'm gonna mark out my levels of resistance, I can take note of this bearish fair value gap. This is a pretty small fair value gap, but don't let it fool you. A lot of times price will even refer to these tiny fair value gaps as a level of support and resistance. As well as we do have this fair value gap above us. If price were ever to break above this bearish fair value gap, then this would obviously be a level of resistance that price would then refer back up into. Now that we marked out our levels of resistance inside the marketplace, we want to be very patient. After identifying our higher time frame key levels, we want to go down to the lower time frames and we want to look for a potential lower time frame change in state of delivery. Essentially, a lower time frame change in state of delivery is an indication referred to maybe as a break of structure or a market structure shift, whatever you want to call it, right? Signaling that once price tapped into this higher time frame key level, price struggled to break above it and we could see back lower prices. And then we can refer to any lower time frame retracements into either a order block or a fair value gap as our lower time frame entry. As well as another added confluence that we can use to this model is these SMT divergences. Since we are trading the NASDAQ, we want to be paying attention to what the S&P 500 is doing. So if the S&P 500 takes out a previous high, then this would then create our SMT divergence. This is a very good confluence, especially when paired with a higher time frame point of interest. So if we can see a SMT divergence plus tapping into this higher time frame level of resistance, either this fair value gap or the fair value gap up here, followed by a lower time frame breaker structure, this is an A+ setup that you guys can trade on a pretty consistent basis. So I'm going to go down from the 1 hour to now the 15 minutes time frame. Now that I'm on the 15 minutes time frame, I want to look for additional potential lower time frame levels of support and resistance. So I'm going to take note of this last up close candle here as a level of resistance, and this is what's referred to as a drop based drop. So we have a initial drop to the downside, price then created this accumulation state, and then we saw this continuation back lower. So this obvious accumulation state right here is a level resistance. So if the marketplace can come back into the same level, it should act as resistance, reaching back below lower prices. And I can use this last up close candle as my bearish order block. Most important thing you want to do now is being patient and waiting for time. So we're coming into the 7 a.m. hour, like we mentioned, which we are trading the NASDAQ. Now we want to anticipate price to come into this level to maybe see a lower time frame break, as well as if we do have that SMT divergence, that would only then be an additional confluence. So we can see the marketplace opened up coming into this bearish order block level. As soon as we came into that order block level, we then see this drop to the downside. Now I'm going to go down to a 5 minutes time frame and see if I can get some additional context. So on the 5 minutes time frame, we can identify that 15-minute order block, as well as we did sweep these previous highs right here. Now I'm going to go over to S&P 500 and see, did the S&P 500 sweep this high as well? So I'm looking at the S&P 500 here, and we can obviously see that the S&P did sweep out this previous high. Yet the high that we swept is a 2:20 a.m. high. But if we look at the NASDAQ here, we can see that same 2:20 high is all the way back up here. So obviously this high here on the S&P 500, the NASDAQ failed to take out. The NASDAQ took out this previous high, which was this 315 high, but it failed to take out this 220 high, which is this London session high. So I'm going to identify this now as a SMT divergence. So we have a SMT divergence at this higher time frame point of interest. As well as we can see, after getting that SMT plus tapping into the higher time frame point of interest, we saw this drop to the downside, breaking back below this bullish fair value gap. This would classify as a CISD. So a CISD doesn't always have to be a breaker structure of a previous low. The main formation of a CISD and how we know price is changing the course of direction from one direction to another is, have we tapped into a prominent level to where price can give a reversal? We've tapped into this order block level. This is a prominent area of resistance. We just given it an SMT divergence, plus we just took out a level of liquidity. Multiple things put together increases the probabilities that price is going to see a reversal at this specific stage. So once price breaks back below this bullish fair value gap, this would classify as a technical break of structure, right? Even though we didn't necessarily break back below this low, I can already deem this as a break of structure long before price ever gets near this low. So these are just some of the key technical things inside of trading that you pick up over time. So as we get this inversion fair value gap here, I can place my short entry, as well as we can put our stop loss back above this previous high. I can be confident that price is not going to take out the same high, because this is the high that tapped into a higher time frame point of interest. So obviously we had this order block level, which was this resistance, and then we saw this drop lower. Following tapping into that order block, then seeing this drop lower, this then creates a strong high. The price should not break back above this high point, so I can be confident putting my stop loss back above that high level, reaching back below lower prices. Like we mentioned, when we were looking at the 1 hour time frame, we had these previous lows down here. During the New York session, price finally gave us the proper setup that we're looking for at the higher time frame point of interest with the SMT divergence to then capitalize on this trade idea, reaching back into those prior daily lows. Now let's see how this plays out. We can see here price came back into our entry inside that inversion level. Price saw this drop lower, creating this 5-minute fair value gap, which if you miss that inversion entry, there's always another opportunity. So we came back into this fair value gap level, saw this drop lower, then we came back into this order block level. Like we mentioned, we had that drop, then we had this base, then we had this drop. So this last up close candle was our order block. Price came back into it once, twice, before then finally seeing that splash lower, reaching back into those previous day lows as our level of liquidity. So if you didn't get into this additional trade, never be in a position to where you're chasing the markets. Instead, be patient and wait for another opportunity to present itself, because I promise another opportunity will. As well as if you're a trader like me, if I got an entry inside this inversion fair value gap, I would scale into this fair value gap as well as scale into this order block level, maximizing on my winning potential, because I already have confirmation that price had came into a level of resistance based upon the multiple factors we talked about. So as the market gives me additional entry techniques, I can obviously add to my win position and make my profits a lot larger. This is just a key risk management tool that I use to maximize on my profits while keeping my losses very small, making me a profitable trader in the long term. And that's going to be it for the video. I hope you guys got a lot of value from this video and learned a lot from it. And before you leave, make sure you guys click that like button, subscribe if you haven't already, and turn on the notification bell to never miss another video. And if you guys want access to my completely free trading course, as well as my brother's trading course and a free trading community, that's going to be the first link description. I'm your new mentor, Arkhamtrades. Thank you for watching. Be safe.